You probably saw the headlines from Ripple Swell 2025. BlackRock on stage talking about trillions of dollars moving on-chain Citadel and Fortress, leading a $500 million investment round. A European stablecoin choosing the XRP ledger as its home. It was the kind of week where every clip looked big. But if you stay with me all the way through this breakdown, I promise you'll understand what really happened under the surface. Why it matters to banks, to stablecoin issuers, to capital markets, and to XRP's role in the broader system. By the end, you're going to see how the puzzle pieces fit together into something far bigger than a conference recap. Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. All right, let's get into what actually happened at Swell. Because the story that most people saw was only about 30% of the full picture. The bigger story was the alignment between regulation, traditional finance, stablecoin issuers, capital markets players, and the infrastructure Ripple has been assembling piece by piece over the last 2 years. The first big shift wasn't even technical. It was cultural. Brad Garlinghouse reminded everyone that the very first Swell, back in 2017, only existed because Ripple wasn't allowed to present at SIBOs. They were outsiders, holding a warehouse event down the street while traditional banks shrugged off blockchain entirely. Fast forward 9 years, and Swell isn't just a crypto conference anymore. It's prime brokers, ETF issuers, global banks, asset managers, custody providers, and market structure experts, all talking openly about tokenizing bonds, equities, cash, credit, and collateral. The people who used to treat crypto as a joke were not laughing this time. They were presenting. That shift alone tells you how much the world has changed. Now let's talk regulation, because this is where the real foundation was set. The United States finally passed a federal stablecoin framework under the current administration, giving issuers clearer rules, disclosure requirements, and oversight. It doesn't solve every open question, but it does something that didn't exist in the US before. It gives banks and institutions something they can actually plug into their risk committees and compliance memos. When a representative from the administration appeared on Ripple's stage and talked about stablecoins scaling globally and digital asset markets reaching tens of trillions, that optimism wasn't random. It was built on new legal clarity. Europe is already living in that world. Under MiCA, Schumann Financial launched EURØP, a fully regulated euro stablecoin, and they selected the XRP ledger as one of their primary on-chain homes. For banks and fintechs in Europe, that's not theory. That's a real issuer with real regulatory approval, choosing XRPL for euro payments and FX use cases. Put US clarity on one side and European clarity on the other, and Ripple positioned itself directly in the middle with RLUSD and these multi-currency rails. Now let's get into the investment round, because this part is massively misunderstood. Ripple announced a $500 million strategic investment at a $40 billion valuation, led by Fortress Investment Group and Citadel Securities, two of the most sophisticated institutions in global financial markets. Alongside them were Pantera, Galaxy Digital, Brevin Howard, and Marshall Wace. These are not hype chasers. These are firms that care about liquidity, settlement, collateral, and how real capital flows across markets. When investors like that buy equity in Ripple, they're not betting on memes or influencers. They're betting on infrastructure. And Ripple is no longer just the payments company that uses XRP. This is where the acquisitions matter. In 2 years, Ripple acquired Rail for stablecoin infrastructure, Treasury for corporate treasury management, Hidden Road for prime brokerage, and Palisade for institutional MPC wallet infrastructure, alongside earlier moves into custody. When you wrap that around Ripple payments and RLUSD, what you get is a crypto-native institutional stack. Payments, custody, stablecoin issuance, prime brokerage, corporate treasury, and liquidity, all aligned with the ledger underneath. This is the part almost no one explained during Swell coverage. Ripple isn't building products. Ripple is assembling a full financial operating system. And the numbers behind that system are no longer experimental. Ripple Payments has processed over $95 billion in volume. RLUSD has crossed $1 billion in circulation not even a year after launch. Institutional clients using what is now Ripple Prime have driven daily transaction counts into the tens of millions, with collateral levels rising sharply. And Ripple now holds 75 regulatory licenses globally, letting it move money for customers without relying on layers of intermediaries. Those aren't proof-of-concept numbers anymore. Those are early-stage institutional numbers. Now let's clear up something most YouTubers get wrong. Ripple the company and XRP the asset are not the same thing. Ripple is a private company that builds regulated products. Ripple Payments, Ripple Prime, Ripple Custody, and RLUSD. XRP is a digital asset that lives on the public XRP ledger. Ripple holds XRP, uses it in parts of its ecosystem, and benefits from the liquidity the asset provides. But investors investing in Ripple's equity are not buying XRP. When Brad said this investment validates a business built on the foundation of XRP, he meant the ledger, the reliability, and the liquidity mechanics. Not that institutions bought bags of coins. Keeping that separation clear is essential for understanding how the stack fits together. So where does XRP actually show up? Think about liquidity and collateral. When euro stablecoins, dollar stablecoins, tokenized funds, and other assets trade across XRPL, there has to be a native settlement asset that isn't tied to any single bank's balance sheet. RLUSD covers the regulated dollar leg. EURØP covers a regulated euro leg. But XRP remains the native asset of the ledger, the medium of exchange that is always available, always liquid, and not dependent on one issuer's credit. And when institutions use Ripple Prime for trading or for collateralized lending around XRP-based products, that's another vector of demand that doesn't require hype or price predictions, just usage. This is where the BlackRock moment comes in. Maxwell Stein from BlackRock's digital assets team told the Swell audience that the infrastructure being built by companies like Ripple can support trillions of dollars moving on-chain not maybe someday, not after 5 more cycles, but as a natural evolution of how financial markets settle value. And coming from a firm that already runs tokenized Treasury funds and works with ecosystem partners that integrate RLUSD as instant settlement liquidity, that statement is not motivational. It's operational. It's a status update from the world's largest asset manager. Nasdaq's CEO reinforced the same message from a different angle. She talked about tokenizing stocks, bonds, and other instruments, not hypothetically, but as a continuation of what's already happening. And she emphasized something institutions care about even more than technology: regulatory clarity, investor protection, and operational reliability. Ripple's pitch is simple. XRPL, paired with regulated stablecoins and institutional grade rails, can be one of those settlement layers. It doesn't need to be the only one. It just needs to be a compliant, reliable, always-on option. And that's exactly how they're positioning it. A few attendees talked about small displays and visual touches around the venue, but none of that mattered. The real substance of Swell wasn't in the Décor. It was in the conversations. The meaningful signals came from the policy voices, the banks, the treasurers, the liquidity providers, the stablecoin issuers, and the market structure teams explaining how they're preparing for real on-chain finance. That's where the actual story was, in the workflows, the compliance frameworks, and the institutional roadmaps being laid out in plain language. Because at the end of the day, Swell 2025 wasn't about retail investors. It was about corporate treasurers evaluating 24/7 liquidity. It was about euro stablecoin instruments being routed through ledgers instead of correspondent banking chains. It was about asset managers exploring tokenized funds. It was about regulators weighing how stablecoins plug into legacy architectures. This was an institutional conference with institutional priorities, and Ripple's stack was clearly built for that audience. So let's zoom out. What actually changed? First, the regulatory ceiling lifted. Between the new US stablecoin framework and MiCA in Europe, stablecoins finally have credible regulatory homes, and RLUSD and EURØP sit right in that zone. Second, Ripple has quietly assembled a bank-like stack. Stablecoins, payments, custody, prime brokerage, corporate treasury, and multi-asset liquidity. Third, institutions publicly acknowledged on stage that tokenization and on-chain settlement are not experimental anymore. They're inevitable. And fourth, the puzzle pieces from different parts of the world: US rulemaking, European regulation, institutional investment, and ledger reliability, all lined up at the same time. If you're holding XRP, the question is not, does this make the number go up tomorrow? The real question is, does this infrastructure create sustained demand for XRPL block space, stablecoin liquidity, and high-quality collateral over the coming years? And the honest answer is, it's starting to. Not at global scale yet. But the mix of players now involved, payment networks, asset managers, treasurers, brokerages, and regulators, looks nothing like the crypto landscape of 2021. The conversation has moved from crypto versus banks to crypto under the hood of banks. That's a very different game. So here's what I'm watching next. First, how regulators implement the new stablecoin rules, because the details will determine how far RLUSD and other compliant stablecoins can go inside the US banking system. Second, how quickly Treasury and Ripple Prime integrate, because when corporate treasurers start using RLUSD or EURØP for intraday liquidity, that's a real shift. Third, whether a US market structure bill emerges and clarifies clean jurisdiction for digital assets. Fourth, whether more euro, pound, or yen stablecoins choose XRPL as their settlement rail after Schumann's move. And finally, what Swell looks like next year, when Ripple merges the institutional agenda with the developer and community agendas into one single flagship event. However you feel about Ripple or XRP, the real message from Swell 2025 is simple. The line between traditional finance and crypto is dissolving faster than most people realize. The headlines captured the excitement. The deeper story was the architecture, the regulation, the acquisitions, the liquidity mechanics, the settlement rails, and the institutional alignment all locking into place at the same time. If you made it all the way through this video, you're now ahead of most of the market in understanding where these rails are actually being built. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.